Okay, hello everybody. This is Real Forex Strategy 247, and this is another class on how to trade the Forex market, and I'm going to be making this a little bit more interactive by showing my face. And just drag this down here, and okay, let's continue with the training. So, Real Forex Strategy 247, how to trade the Forex market, and what I'm trying to achieve with this is I'm trying to empower lives with the power of foreign exchange. So today's topic will be dealing on candlesticks. So candlesticks. Okay, just setting my camera very well, making sure that it's showing me well. Okay, so hello everybody. So yeah, okay. So like every other class, I always put my an illustration of what the class is going to be about on the first screen, and you can see right here. Just zoom this close. We have different type of chart pattern on the screen. Different type of candlesticks on the screen, and we can see an army, we can see a piercing pattern, a dark cover, a doji, and an engulfing pattern. We can see a lot of candlestick here. Now we're going to be talking about all this and more, right? So that's what this class will be all about. Now let's move on to the next slide. So introduction to candlesticks. Now candlesticks chart is the most used and most important among several other type of charts. Now, what this means is there are other type of charts quite alright, but candlestick chart is a superior type of chart that actually tells you what the price is really saying. Unlike every other candlestick chart, there are different type of candlestick chart. Ones that I know are the line chart and the bar chart. Now, these two other type of chart is different. They are different, totally different from the candlestick chart. Now, why use candlestick chart? It goes in depth to interpret the market like no other chart. It tells you the story the market is saying. Now, what this is candlestick chart, unlike the other bar and line chart, it actually tells you the story of the market. It tells you what the market is saying, right? It tells you a lot about what price movement is saying. And with all this, we have chart patterns that to back that up, and which is amazing. Now, a little bit about the history of candlestick. Candlestick chart are thought to have been developed in the 18th century by Munehisa Homa. Is a Japanese rice trader. In the ancient time, during the 18th century, this guy, this Munehisa Homa, was the one who developed the Japanese candlestick chart. When you see a candlestick chart, the real name is actually Japanese candlestick chart because it was developed by a Japanese rice trader. They were introduced to the Western world by Steve Nielsen in his book. Now, what Steve Nielsen did was that in the past, there was nothing like candlestick chart in the Western world. So, what the Western people actually used to predict price movement was a line chart and also a bar chart. Now, what Steve Nielsen did was to research about this Japanese candlestick chart, and he wrote a book about it, and he introduced this type of chart to the Western world, which has now become the most popular type of chart in the world right now. Every single trader, most of all the traders in the world, uses a Japanese candlestick chart. Japanese candlestick charting technique, they are often used today in stock and forex analysis, along with other analytical tools such as Fibonacci. Now, Fibonacci is also a tool in the MT4, you guys might not know where it is, but it is there. It's a kind of tool that you use to predict price movement. You use this Fibonacci to predict price movement. It's a miracle to the forex world. Actually, it's incredible how it actually predicts price movement from extension to retracement. Everything is just amazing. A lot of traders will talk about this, and they won't say anything less than what I am saying now. That the Fibonacci tool is an amazing tool, and in future videos I will introduce Fibonacci to you. I don't know how they calculate the ratios, but it is a tool that I know how to use, and I'm going to be showing you how to use that tool, Fibonacci tool. So let's move on. We are all about the candlestick right now, so let's just leave Fibonacci aside for now and focus on candlestick analysis. So interpreting candlestick. Now this year is a proper candlestick. Yeah, the green one is called a bullish candlestick, and the red one is called a bearish candlestick. I know some of you guys must have known about candlestick because you can see it in your MT4. That is what is moving. This is exactly what is moving on your price. When you open your chart right now, you see bunch of all these green and red candles type of candlesticks all over your chart. So this is what is there. So how do you interpret this candlestick? How do you interpret the candlestick chart? Now the green candlestick is called a bullish candlestick, and it goes up on a chart. I don't know if you understand what I mean. When you see a green candlestick on a chart, it represents going up. But when you see a bearish candlestick on a chart, it represents coming down. Now, how to interpret the bullish candlestick and the bearish candlestick? Now, when you see a bullish candlestick on a chart, it opens low. It opens at a very low price. It opens low around this section here. It might trade down a little bit and continue up, trade up a little bit, then come back down and close. So that is how this candlestick formed. I hope you get my illustration. Don't mind my drawing. So this when it got to this lower price here, that lower price, we call it wicks. It's like a candlestick and the thread on it. When you see a thread on the candlestick, you call it wick, and you just light the fire on it. Yeah, but this one you don't light any fire. We just call it wicks so that people will understand it, right? People will understand what it actually means. So that is for a bullish candlestick. It opens low. It might trade low a little bit, continue up, trade a little bit more up, creating a high price, which is also called wicks, which is also called a wick, and it will come back down and it will close. And that is how it is formed. Now, continuation. The same thing with a bearish candlestick, a red candlestick, a candlestick that is coming down. What actually happened with this candlestick is it opens at a very high price, right? It opens at a high price. It will trade up a little bit, then it will reverse back and continue down. It will trade down for a very long time, then it will come back up and close. Now this is how this bearish candlestick is formed. This is how this bearish candlestick is formed. It opens high, unlike the bullish candlestick which opens low. This other candlestick opens high and comes all the way down, while the bullish candlestick opens low and goes all the way up. So that is how to interpret this candlestick, and you can see labels all over the chart. Now the candlestick, this large part of the candlestick are called body. That is the candlestick body, the real body, even with the bearish. And the little thread-like looking stuff are called wicks, or lower shadow or upper shadow. So that's how we name them. So moving on. Next slide. Next slide. So types of candlestick and where to use them. Now we have bullish candlestick. Bullish candlesticks are found going up on a chart, and this begins to take effect after it must have gotten to a resistance. Now I'm going to be taking you to a chart, a real life chart, and I'm going to be explaining in depth on this bullish candlestick. I'm going to be talking about the bearish part of this candlestick, of this bullish candlestick, and the bearish candlestick. I'm going to be doing it with the chart, so that when I come back and continue on the class, you would really get what I'm talking about. So I'll just quickly go to the live chart right now. Now, as you can see, we are on the live chart, and you can see where we are at. Now, this is support, right? And this is resistance. Those are the most one of the most important thing you need to always have on your chart. You need to have your support and resistance, because it will help you a lot. Now, you see that the price action was actually trading down, right? When it got to a support, what actually happened is it started giving us a bullish candlestick, a green candlestick, a candlestick that is going up. If you see a bullish, a green candlestick, a candlestick going up without getting to your support, then just know that candlestick is not strong enough to move price. So you cannot go into a trade with that. You have to wait for your candlestick to get to your support before you get in. As you can see on the chart, in the past, a bullish candlestick actually formed, but what happened? It continued down. Only when it got to a support area, when bullish candlestick formed, it took the price all the way up. It went all the way up to a resistance. Now, when you get to resistance, now I'm doing this so that I will not have to come back to the chart anymore. When you get to a resistance, what you'll be looking for are bearish candlestick going down, red candlestick. When you get to your resistance, what you will be looking for is a red candlestick, a bearish candlestick, a candlestick that is going down, or else perhaps the candlestick broke the resistance up, then you can start looking for a retracement and more price action. So what we have in this other part is, now the price got to a resistance, and what happened? We started seeing red candle. We started seeing candlestick coming down. We started seeing bearish candlestick. That is what you should look for on a resistance. Now let's move on. Okay, so next slide. we have bearish candlestick. Bearish candlestick are found going down on a chart, just like the chart I showed you just now. So you when you see a bearish candlestick, they are found going down on a chart, and this begins to take effect after it must have gotten to a reversal point on the chart. This reversal point for a bearish candlestick is called resistance. Now let's move into support and resistance. We'll just explain what reversal point is about. Now, reversal point are strong places on the chart where price turns and go the other way. These places on the chart are called support. And we're going to deal with support first. Now, support are for bullish candlesticks. I need you to understand this. Supports are for bullish candlesticks. Support are found below price movements. You see them below. Support are found below price movement. When price gets here, it turns bullish and starts going up. This is where you see bullish pattern. We are going to be going into bullish patterns, different type of bullish patterns that you see on when price gets to your support area. We're going to be talking about all these patterns that you would see when price gets to your support and resistance area. So we'll deal with the bullish pattern first. So another strong reversal point is called a resistance. Resistance are found above price movement. When price gets here, it turns bearish. Let me move this a little bit. Okay. It turns bearish and starts going down. This is where you see bearish candlestick pattern. When price gets to a resistance, now the reversal point for before you start seeing bearish pattern is a resistance. Now that is the reversal point for a bearish pattern, a red candlestick, a candlestick that is going down. So when it gets to a resistance, you start looking for this bearish pattern. We're going to be talking about this bearish pattern later. So moving on. Now, this is an example of a bullish pattern. Now, I talked about when price gets to a resistance area, a support area. Sorry about that. When price gets to a support area, you will start seeing candlestick pattern, a bullish candlestick pattern, patterns that says that market wants to start going up, right? You start seeing all these kinds of pattern. Now, this is the first kind of pattern that I'm going to be talking about, which it is called a bullish engulfing pattern. How does a bullish engulfing pattern looks like? So, viewing the chart, I'll zoom it close. Viewing this chart, you can see a bunch of red. You can see a bunch of red candlestick coming down from the chart. Ignore this green. You can see a green candlestick, but if it hasn't got into a support area, then it is not valid. Then you can see how there was a small little red candlestick, and you can see how this green candlestick just covers it up. It started from the lower point of the chart. It started from the lower point of the chart and just went all the way up and covered the whole of this red candlestick. Now that's why we call it a bullish engulfing pattern. It's a green candlestick that signifies that okay, price wants to start going up from the downtrend after it has gotten to a support area. Remember this, you need to look for all this type of pattern only when it has gotten to a support area. If you're looking for a bullish candlestick, you need to look for it when it gets to a support area. Now you can see on the live chart, right? You can see on the live chart, we can see two places where sorry about that. Okay, made a mistake with that. I'll just zoom out this and I'll go back. Okay, All right, I am right where I am, so I mistakenly tapped the next slide. Okay, so you can see bullish, this bullish engulfing pattern at the support area. You can see another one here, right? When this bullish engulfing pattern happened, you see how price moved up, it retraced back down, another bullish engulfing pattern, then you see how price just went up into the future. And that is how all these chart patterns, all this candlestick pattern works. So let me move on to the next candlestick. I believe you guys already saw the next slide. So this is another type of bullish bullish pattern. This is not a bullish engulfing pattern. This is an hammer. It is different from a bullish engulfing pattern. You can see on the screen how it looks like an hammer. It has a very small body, and it has something like an handle. You can see that it looks somewhat like this, like an hammer. And this tail, which is the wick, which is the shadow, the dark shadow of the candlestick, the wick, we call it wick, is looking like an handle of the head of the hammer. So that is why it is called hammer. Just so simple to recognize on a chart. So you can see here the real illustration of it. You can see how it looks like here. So price was coming down, then boom, price opened here, went all the way down. Now let me do an explanation of what this looks like. Now price opened here, right? Price went all the way down, right, and came back up, and it surpassed this one. It surpassed where it opened. It surpassed where it opened and closed above it. That's how the hammer is formed. That's how the hammer is formed. So when you see it on chart pattern, you likely recognize it because they are very they happen a lot in price reversal point, which is the support. Now for this candlestick pattern, which is called an hammer, you only see it around support area. If it's not a support, then it is not strong enough to tell where the market is going. Okay, let me show you how it looks on a chart, a real life chart. I think I have one here. Okay, so you can see a lot of hammer on this chart. You can see one here, you can see another one here. You can see that it's on a support area, but this support was not that strong, so price continued going down. Then it got to a very strong support. Then you can see the hammer forming. You can see the hammer forming here. Then price continued up. So that's how to use all this pattern. And when the pattern form, you can also wait for a confirmation bullish candlestick before you enter into your trade, and so that your stop loss go down here. Then you wait, and you trade it, the market up. Now moving on to the next type of pattern. I don't want to spend much time doing this. Okay, so let's just move on to the next type of bullish pattern. So this one is an hammer, and we have what we call an inverted hammer. It looks like an hammer, but it is upside down, right? It is upside down. That is why it is called inverted hammer. You see that it when I zoom the chart close, you would see that it really looks like the former pattern that I talked about, but only this time the wick is up. The wick is up. The wick is up, and the real body is down. So just like I explained the former, how this happens is price opens here, right? Now price will trade up high, then it will come back down. It will come back down. It will not get to where it started open. It will just stop and close a little bit before it gets to where it opened, and that is how it is formed. You can see that it is green. An hammer or an inverted hammer can be red also. It can be a red candlestick, it can be a bearish candlestick, it can be a candlestick that is going down, but that is not strong enough. If you see such things, you will be waiting for a green candle just to signify that, okay, that pattern that has just formed is concrete. But when it's green, it is stronger. You can also wait for another green candle to confirm it, but you can also use it like that. It will be very, very good to wait for the next green candle to form after an inverted hammer has formed, just like what we have here, just like what we have there. So it is a 3 candlestick pattern. We have the red, we have the hammer, and we have the green confirmation candle. You can just enter here around this candle, trading it up. Potential direction is up. So that is what an inverted hammer looks like. So moving on. So this pattern is also a bullish pattern. It's also a bullish pattern, and it is called a morning star. It is called a morning star. How does a morning star form? It is a morning star is a 3 candlestick pattern. That if you don't see this 3 candlestick, then it is not a morning star. We can all see how it looks like on the chart, right? We can all see how it looks like on the chart. It started with a very strong red candle, bearish candle, a candlestick that is going down. Then we can see another candle. It is red also. It can also be green. Sometimes it can also be green, but it has to be very, very small candlestick. It doesn't if it is a big candlestick, then it is not a morning star. The second candlestick has to be very, very small, then it will end up with a long green candlestick. Almost, it can be as strong as the red candlestick, or it can be almost as strong as the red candlestick, or it can be more strong than the red candlestick. But just know that you have to have a long red candle followed by a small bodied candle, then a long green candle, which is a bullish candlestick for the morning star. And you can only find this kind of pattern at a support. You can only find it at a support. Okay, so let's move on. Okay, I haven't shown you the chart, so this is another illustration of it, a morning star pattern. You see the red body, you see the small body, then you see the green body. So that is how you trade it. Now this red body can actually gap down, really, and your next body can just gap up a little bit, and it's very, very amazing how this pattern forms every single time it forms. So let's view a real chart and see how it looks like. So alright, we have only one on this chart. We can see how it looks like now. This is where you find, you see, at a support, right? and you see the black candle, you see the other small bodied candle. Actually, this small bodied candle actually looks somewhat like an hammer, but it is really not an hammer. But we can see it looking like an hammer. And the reason why I'm saying it's not really an hammer, because it has that small wick to the top. So, and you can see how it was followed by a white body. The reason why I used another color of chart for this is because I want you to be able to identify this chart patterns, this candlestick pattern in any color of chart that you are using. But I strongly recommend you use the green and red chart on any kind of background you want, but it has to be green and red. But you can also use the white and black chart, the green and white chart. There are a lot of them out there. So let's move on. We all recognize what a morning star looks like now. So let's move on to the next slide. Okay, this is also a bullish pattern. This is also a bullish pattern, and this bullish pattern are called three white soldiers, or we can call it three soldiers, three rising soldiers. So if your candlestick chart is not a white and black chart, you can call it a three rising soldiers. Okay, just like this chart right here, it is not white and black. So what you call it is a three white soldiers, three rising soldiers. But if it's a black and white chart here, you can call it three white soldiers. So anyhow you would like to call it, just know that it has to be rising and it has to be three for it to be valid. And I recommend that you use it when the price is at support. And before you use it, make sure that the three white soldiers actually breaks a mini resistance going up before you enter. That is the most profound way to use this chart pattern, bullish pattern. So you can see what it looks like. It's a three type pattern. Now I need you to get this. The three candlestick pattern has to be very strong. You can see that, okay, the first candlestick was strong but not that strong. The second candlestick had wicks. Okay, the first and second candlestick had wicks, but the third candlestick didn't have any wick. It was very, very strong. Now the third candlestick too can have a wick, but it has to be very strong. It cannot be a small bodied candle. If the third candlestick is a small bodied candle, then it is not a three rising candlestick pattern. You have to leave it alone and just look for other options. And I recommend that I'm just going to show what I'm recommending on the other chart. Let me just delete this off the chart. Sorry. Okay, so this other chart. Now we can see that we are at a support area, right? Now what I said that I recommend is that before you use the three rising soldiers or the three white soldiers, make sure that the three rising soldiers actually broke a small resistance. If it doesn't break a small resistance going up, it is also valid. But when it breaks that small resistance going up, it is more valid, because then you have a strong point to to bargain with. Forex game is all about probability. Now you have to know how to use your probability right. Now the greatest, it is more probable to go up if it actually breaks a mini resistance when the chart pattern is actually forming. So that's why you need it to break a mini resistance, but it might not break a mini resistance. It is also valid, but not as valid. Now what I talked about, that the pattern has to be strong. You see over here that the pattern was strong. There was no wicks, right? There was no wicks, and it was at a support area. Now we the same kind of pattern we saw here, but check out the candlestick. Can you see what the candlestick looks like? The first one is strong, the second one is not that strong, and the third one is now very, very small. Now don't trade that type of pattern, and you can see that it is not as a support, nor is it at a it's almost getting to a resistance, but it is not at a support. This is supposed to be a bullish candlestick, and it's supposed to be traded when it's on a support area, not a resistance. Not a resistance. I repeat. So let's move on. That is it for the 3 white soldiers. Oh, okay. All this candlestick pattern, they love using. The reason why they use this military tone is because it was Japanese. It's created in Japanese, and you know Japanese, then they love this military stuff, so they imbibe it to everything they do. There are other patterns by the candlestick by the Japanese that also use military terms and all those strategies and stuff. So let's move on, or should I? Okay, let me just do a recap. I will be ending this session here. I wanted to spend 40 minutes on this class, and the next class will be continuing from where we stopped. We stopped at the 3 white soldiers, the 3 advancing soldiers, the 3 rising soldiers. Those are names that you call this last pattern. So I'm just going to do a recap of what I have talked about so far. So I'm just going to swipe back the slides and get it. So I started from here. Okay, I talked about introduction to candlestick, and I talked a little bit about how candlestick came to existence, a little history. I love imbibing a little history to it, so that we just know a little bit of it. And if you really want to read about it, there are books that you can read about the history of the candlestick chart pattern and how it came to be. I have some of them. So I explained how it is used and why it is important. And how famous it is. It is the most famous kind of chart pattern, and I talked about how to interpret the candlestick, how it forms, how the candlestick forms really. We talked about how it forms really, and that's the interpretation. And I talked about types of candlestick and where to find them. I talked about bullish candlestick, bearish candlestick, and where to find them, reversal points, support areas and resistance areas. And I talked about a bullish engulfing pattern. You can only find this bullish engulfing pattern on a support area. You can find I also talked about the hammer, and hammer also you can only find it on a support area. I talked about inverted hammer, also support area. I talked about the morning star, and I talked about the 3 rising soldiers, the 3 advancing soldiers, and you can only find it at a support area. So this is where I'm going to be closing this video, this class, and I'm going to be continuing from where we stopped today next week. Thank you for being here.